seeing a recovery in the regional bank stocks, but over the course of the last month or so, we've seen a dramatic rise in shorting the U.S. regional banks in particular. Last week, this prompted calls from the American Bankers Association as well as others to call for the halt of short selling in some of these regional banks. Now, for now, this is an idea that the SEC and even the White House seems to have pushed back against. Remember, this is something that we saw during the financial crisis when a lot of these banks were in free fall. The regulators came out with a list of some 700 names that you could not short anymore. You had banks this week, last week, I should say, like PacWest, it wasn't PacWest, it was Western Alliance, I believe, blamed short sellers for planting stories that suggested that things that were worse than they actually were. In this case, referencing a story in the Financial Times suggesting that Western Alliance was looking for a buyer of their assets, something that they categorically denied. So, are short sellers to blame for making this crisis worse? Let's bring in Brad Lamensdorf. He's core portfolio manager at the Ranger Equity Bear ETF. Brad, we know that typically you do come at things from the short side, so I imagine you'll say, no, short sellers are not to blame here.
Well, look, I'm a long short manager too. I have long portfolios that I look at, so that's not predominantly what I have a game and lots of different things. But look, I think that the short sellers are on these stocks. There's no question about it. However, when you look at the companies, like for instance, the short sellers were on Carvana too. I mean, we shorted it at $2.90. It's at $8. We covered it around 50 or 60. So I'm just saying the reason that these companies are in trouble is because their lines of businesses are poor. They are huge in office. They are huge in this phenomenon where they were borrowing short and lending long. So a lot of their businesses aren't very good, and I think that they're calling into question the regional banking business model. Like, how are these guys going to make money going forward? Like, they've been getting into all the bad lines of business, so now it's showing up. So how are they going to get themselves out of it, and what's their business model? They certainly can't compete with J.P. Morgan. Does
that mean that you expect more failures of U.S. banks and that you would still be shorting a lot of these banks, even with, we get a lot of volatility. I mean, how do you as a short seller deal with a bank stock that pops 20%, even though it's still well off of where it was a month ago?
So look, so take a step back. So I'm a short seller. I have over 60 to 70 positions. One position like WAL, for instance, it might be 1.5%. So if it moves 30% against me, it costs me 60 basis points, which, is, I've got 70 positions. There's lots of companies moving around all over the place. So I'm not that, but what I'm trying to explain to your viewer is that the most volatile time of any stock market or any stock is when you're in a bear market. That's a statistical fact. So expect volatility. They're not going to go to zero overnight. We trade them ourselves. We're back and forth. We had bought a bunch of bank stocks in March when it blew up. They bounced. We reshorted them. It blew up again the other day. We covered them. We'll be laying them back out. And by the way, we're also short a lot of consumer finance, a lot of auto finance that aren't considered banks as well, that also would fit into this area that we're talking about that's in trouble.
I wonder about the club of short sellers as well, and whether that club has fewer members these days. A few years ago, it was high-profile short seller Andrew Left who decided to give up shorting and kind of the meme stock phenomenon, but even a regular portfolio manager who for decades ran a long short book just was tired of getting, his hat handed to him on the short side of things and now deciding to go long only. Are there fewer short sellers out there?
Without question. No question about it. There's fewer and fewer. One of the things that we love about our product that we've created, the symbol is HDGE on the New York Stock Exchange. The reason that our product is available and works is because it's approved for all the platforms. We're not an inverse product. We're an active ETF, which means we mark at the end of the day with an NAV. We don't have the compounding issue. There's nothing in our prospectus that says, hey, you can only hold us for a day. So when you are trying to get short exposure, here's a situation where normally if you shorted a stock, you have unlimited risk and limited reward. When you're buying our ETF, your risk is literally to zero, and that's your risk. So it's not unlimited. We would be having to cover our portfolios, internally. So, I think that for the average person to go out there and try to do this, I think it would be very rough. But I do think that when the markets do get rough, which we continue to expect them to do, the interesting thing about when Powell was talking the other day that I thought was super interesting was, one, he said the banks aren't in trouble. So they're not, in my opinion, while people are concerned about the short ban and, the reality is that Zion, Co-America, I mean, you could name 5 of them, all of them together are as big as Silicon Valley. So that they're not massive banks. It's not Bank of America going down. It's not Wells Fargo going down yet. I think that if those were to start getting in trouble, which they may, then you would have some problems. But remember, the whole problem here is that office is melting down, and companies are having a very difficult time adjusting to the new interest rate environment. It's going to take quarters for them to work out of these loans.
And just as you were talking about that product, HDGE, I do note, and I have to bring up that, so far this year, it has underperformed. And even over the past year, where the S&P is basically flat, it's down about 8%. These have been, obviously, last year were challenging markets, but recently has been sideways market. How do you look at sustained outperformance through this?
So our portfolio tends to be super high beta. So for us to be, for the markets to have bounced since October and us to be a few hundred basis points or 700 or 800 basis points behind the index really doesn't mean as much to us because our investors are expecting significant downside capture. And when the markets were down 20% last year, we were up almost 35. So we really give a very nice bang for the buck. And what can I say? Right now, we're very, very invested. We don't have to be that way. We could be 30 to 50% cash if we wanted. But we think the dividend yield is too low on the S&P. We think that a 2% dividend yield for this environment is reasonable. And that's 3,000 on the S&P. So that's 20 to 25% downside in our opinion. So we want to stay in the juicy stuff, and we may get thrown around a little until the real sell-off occurs again. But we don't think we're out of the bear market.